We were just touching on great performance from the Magnificent Seven. I do have to ask you after this November to remember how much of this rally continuing is dependent on a dovish Fed.
Absolutely. Well, to be honest about it, it's everything. The way that this market is behaving is perhaps unsurprisingly indicative of this idea that the Fed is absolutely done with the hiking cycle. You know, this is a market that is behaving in a way that is expecting cuts really to be coming through early doors next year. And that, in a way, is a good thing. You know, we've had a lot of data points to suggest that is something that the Fed might be comfortable doing. You know, that there is a lot of heat coming out of the economy. But the flip side of that we cannot forget is that interest rates tend to get cut at times of economic difficulty. And of course, I'm referring to the risk of recession, which means that actually if that lands in a harsher than expected way, this could spell a little bit of trouble. But of course, we'll have to wait and see on that one.
We absolutely will have to wait and see. I also want to talk to you about bond yields. We were talking about the 10-year earlier, down about 70 basis points from its high of earlier this year at just about 5%. How important are bond yields when we're talking mega cap tech? Obviously, the higher the yields, the higher the cost of capital. But a lot of these companies have really, I guess, robust cash flow.
Absolutely. So traditionally, that relationship used to be, in my opinion, a lot tighter. But now when we see how these markets kind of interact with one another, you see the level of the pullback when yields first spiked. I'm talking here particularly about the Nasdaq. It was really relatively limited when you look at the scope of how high yields were going. And what this is telling me really in a broader sense is that markets are far more interested in the fact that a lot of these tech companies, the Magnificent Seven that you were talking about there, in a lot of instances, they are printing cash left, right, and center. And valuing those future flows is now a completely different task to what it used to be. You know, they are printing, I've heard this described as they are printing money on money in so many of the cases here. And that really is what matters. And that's where we're seeing a little bit of a disconnect compared to the traditional relationship.
Let's talk more broadly about tech. We were just talking about the ARK Innovation ETF having its best month ever. Generally, when we talk about the ARK Innovation ETF, we're talking high growth tech, but also, just riskier tech. A lot of people like to use the term risk on. Do you see continued confidence in this riskier or high growth trade? And do you think investors for at least the rest of this year will continue to put money in the ARK Innovation ETF and other similar investment vehicles?
Looking specifically at December, I don't see right now an initial kind of pinch point where I can see something really spooking markets in that sense. But I think what's really crucial is as we look into Q1, and I think when we start to get those data points about how stocks have performed, particularly those consumer-facing angles, how they have performed over the festive trading season, for me, that's going to set the tone for the macro, set the tone for economic policy. And it's at that point that I think we could see a little bit of shakiness on there, because really, as much as investors in the market, they're loving tech right now, and for a lot of good reasons. Fundamentals cannot be forgotten, and unfortunately, sometimes in these riskier, higher growth options, those fundamental strengths, the good old profit and cash flow, and can sometimes not be a priority, shall we say? So I think a refocus on the fundamentals could hurt the riskier options as we head into Q1.